Kurt Reiman is next. Kurt is with BlackRock, and same thing. When I contacted BlackRock and said, could we get one of your top speakers to talk with us about global macroeconomic issues, which are so prevalent right now, they came back with Kurt, who's one of their top people. Kurt's a managing director, a member of the BlackRock Investment Institute, senior strategist for North America. And in this role, he contributes to the formation of BlackRock tactical investment views and delivers the team's macroeconomic and financial market outlook to investment professionals and media throughout the US and Canada. Next paragraph, he's had a very long experience with BlackRock, almost a decade. And prior to that, he was with UBS and began with the G7 group in Washington, D.C. Kurt got his BS degree in business and economics from State University of New York College at Plattsburgh, which is a beautiful town on Lake Champlain. If you haven't been, very, very, very beautiful place. And then he also has an MS degree in international relations and a concentration in international economics from Johns Hopkins at the Advanced International Studies School there. And so it's my pleasure to introduce Kurt to you today.
Hi, Leonard. Hi, everybody. Can you hear me all right?
Yes, we can.
If so, oh, excellent. Okay, I'm hearing that the answer is yes. I can't hear you back, but it's great to be with you all. I'm really pleased that we have this opportunity to be together. I think that I was just joining the last little bit of the prior speaker, and it seems like if all of the speakers are as good as Scott, you're going to have a great session today.
Sure.
Wonderful. We're about to embark next week on our annual Outlook Forum. I'm part of the BlackRock Investment Institute, and our job is to try to help our investors become even better at what they do. So we create a bunch of macro and financial market views that we share with investors at BlackRock, and we foster debate. That's really one of the key pieces of the BlackRock Investment Institute's mission, is just to get people to sit down, share ideas. Oftentimes, we don't come up with the answers to all of the questions, but we do a pretty good job of shrinking the question mark and understanding where the variance is in the room as to the outlook. So in June, we got together and we tried. Typically, we have a mid-year update discussion, and we just sit together and come together, try to figure out where the economy is headed, what might need to be changed since we last got together in November. And I found that in June, the discussion was really pretty tectonic in nature. It wasn't one of these refreshes or updates. It was rather, the markets were down at this point. I think stocks were down 20%, bonds were down by a similar order of magnitude. And trying to figure out where things were headed and understanding the macro context was pretty critical. So one of the observations that came through was this idea that the world that we've been in, and the goalposts here, not to do much here to carry over the football analogy, but from the mid 80s to just before the pandemic is a period of time that economists refer to as the Great Moderation. And what I'm showing here is not actual GDP or core inflation, because if this was GDP and it's spiking, I think based on the chart that Scott showed earlier, you'd probably wonder which planet I'm on. But this is the volatility, so the standard deviation of output and prices, and both were unusually low for an extended period of time relative to the 70s and relative to where we are today. And economists have a name for it. They call it the Great Moderation. There's been some debate in academic circles as to whether this was somehow enlightened policymaking or some sort of divine intervention on the part of policymakers to get us there. We happen to think it's more a function of luck. But you can think of probably a lot of the forces that kept inflation constrained after Volcker stepped in the early 80s to really bring inflation expectations down and arrest these rising price increases. But beyond that, why it stayed low, and why bonds were a negatively correlated asset class that provided a real return for generations, is a bit of a mystery. But I think we can point to a lot of secular forces. For example, the global supply of labor just becoming ever larger, and that putting downward pressure on the ability of workers to bargain. Or you think about putting, satellites in the sky that can geolocate energy and materials, or the fact that now our iPhone can effectively render obsolete 1,000 other potential devices that we would have had to buy. The force of technology keeping prices constrained. Demographically, we could probably also point to a few other ideas. The aging of populations, and then I think the last piece would be just over the last 10 years, last 12 years, the deleveraging that's gone on in the global economy, at least U.S. private sector leverage coming down, and how that restrained demand. And so we're seeing a shift from a world that was defined by abundance and production growth increasing over time because of the availability of inputs, to one where it's more defined by scarcities. And that's going to define the outlook for at least the foreseeable future. And it's across a range of dimensions, right? It's not just that we have energy and food outages because of the war in Ukraine, or because you told workers that they were essential for 2 years and now they believe it. For example, right, truck drivers and cashiers that the future of work experts said would be out of a job because of automation, but are now in high demand. It's beyond the fact that China hasn't been fully able to reopen its economy because of COVID lockdowns and the difficulties that creates restocking shelves. It's also about the rewiring of global supply chains, right? That started before the pandemic, the change in immigration patterns that started before the pandemic. All of these create scarcities, and in our view, keeps inflation elevated relative to where we were in the years following the financial crisis. Our view is that inflation settles back, but it settles back to a level that's as much as 50% to as little as 50% to 100% higher. So say from a range of 1.5% to 2% before the pandemic to something that's closer to 3% or maybe even slightly higher. And I say that also with the acknowledgement and the knowledge that today's central bank fighting of inflation comes with costs. And, to Scott's point earlier about the Fed raising rates and not even during the Great Moderation being able to achieve soft landings, it's really hard now. And what we're actually talking about is a Fed that is engineering a recession, not responding to a recession with cutting rates, but rather destroying demand in order to bring about a better match between the economy's ability to supply at a lower inflation rate versus the demand that we've been seeing. So these outages are keeping us from returning to trend. It's making for greater trade-offs between controlling inflation, which is on the vertical axis, and controlling output, which is on the horizon. That trade-off wasn't as great in the years before the pandemic. Now we think it matters more. Again, this is for illustration purposes only. It's not meant to be specific, but I think it's a helpful guide. As far as those supply constraints, I just want to give you a few proof points, and then we can move on. But just thinking about in the labor markets, we did an interesting study where we looked at the participation rate, which is the number of people working in an economy, not the employment rate, which is the number of people who want a job, that have a job. This is different. It's the share of the population that's working. We looked back to the 1950s, and at the start of an economic contraction, we followed the participation rate out for 7 years. And what you find is that in the 50s and in the 60s and 70s and 80s, there were times when participation rates rose at the start of an economic downturn. Why is that? I asked that question when I first looked at this chart, And the answer is, well, you're bringing women into the job market, disadvantaged socioeconomic groups into the job market. A lot of forces secularly acting as an increase in the availability of labor. To say nothing of the fact that since 2000, with the entrance of China into the WTO, we're counting billions of workers into global markets. Well, if you look at the trend in developed worlds, and we're showing the US here, but in recent times, those are the colored lines, and the bright red bold line shows the pandemic experience. We've just been in a secular phase of fewer workers, and that's because of retirement, which is a good thing. The pig and the python baby boomer generation is moving out of the prime working years. So we kind of know why this is happening, but we lost basically 11 million jobs evaporated during the financial crisis, during the pandemic. 8 million jobs, workers returned. That's a deficit of 3 million workers. How do you bring about balance? Well, one way you can do that is to destroy demand, which creates higher unemployment. How much higher, though, is really important. We'll talk about that. On the right side is instead of looking at the shortages from the lens of the labor supply, which is clearly constrained, we look at it from the point of view of, well, how have we changed our spending? Because much of the inflation that we saw coming out of the pandemic was a function of what we bought and whether they were available, and we gorged on goods to the extent that our share of spending on goods went up by several percentage points. That's this yellow line on the right axis, right? So it jumped. And what I find interesting is that even though we've reopened, right? So reopening means what? We're going out to eat, we're traveling more, we're going to the dry cleaner, we're getting our hair cut, all of which are services. And yet the share of services spending hasn't risen, or in other words, the share of goods spending hasn't gone back to pre-pandemic levels. Why is that? I mean, and the reason is, and this might be somewhat convoluted, but it's not just about quantity. So yes, on the services side, quantities are up. It's about volume. It's about the relative volumes of goods and services. Volume is price times quantity. And what you can see also is the red line, which is goods inflation less services inflation. And goods inflation has been far exceeding, like talk about the difference. It was, at least recently, goods inflation was running in the teens, and services inflation was rising, but it was rising only into higher single digits. And that's the gap that we're showing as the red line. It's only starting to normalize. So the point being that the services side of the economy is constrained because of the labor supply. The goods side of the economy is constrained because of restocking inventories and a mismatch between what we want after the pandemic and what we wanted during the pandemic. I think there's a lot more that we could talk about, but I just want to introduce and share our point of view, which is this isn't just an overheating economy because the economy is operating above potential, and so demand is above supply. And all that has to be done is for the Fed to engineer a mild, soft landing, or even undershoot, sort of hit the brakes a little bit, and then we get back to trend growth, full employment, price stability. This is one about deliberately destroying demand in order to get back to what the economy can produce at a 2% rate of inflation. So this chart, which I call the brick breaker chart, is just showing US GDP trend from pre-pandemic times, which is the upward and to the right gray line, as well as actual GDP, which is the drop in the pandemic and then the recovery to almost trend by 2021, only to fall back a bit, right? Because as Scott mentioned, there was a contraction in the first half of this year, mild, albeit. And now central banks are tightening financial conditions. They're trying to press on demand. They're slamming the brakes. And the dashed line is what we estimate as the ability of the economy to produce at a 2% inflation rate. Can we get there? Sure. Does the Fed have the tools to get us there? Yes. What does it involve? In our view, a 2% contraction in the economy over the span of a year or shorter than a year. And that's a deep downward turn in the economy, deeper than we're forecasting. What I want to point out here is that there are those who are forecasting this outcome. There are a number of investment shops that think that the economy is going to experience this type of massive recession in order to get inflation back to 2%. And that's the ideal policy goal in order to have not a de-anchoring of inflation expectations. There's another view. That view would be along these lines, that all we have to do is raise interest rates for a mild uptick in unemployment, and inflation gets back to 2% within a year or two. Does that sound naive? Well, if it does, that's what the Fed is saying. That's what the Bank of Canada is saying. That's what the ECB, they met yesterday. That's what the ECB said this morning. Only the Bank of England is actually acknowledging the recessionary implications and the economic trade-offs of getting inflation down to target, which is material. So, I mean, I don't have to tell you that this is the tightest move in policy rates in a generation, with the exception of the Volcker years. So that's pretty obvious. 75 basis points are priced in. Again, this is telling you a similar story. But I think what we have to think about is the constraints on policymakers getting inflation down to 2%. And we're already starting to see evidence of this in the UK. So what I'm talking about is you've got a Bank of England that's raising policy rates to destroy demand to get inflation down. Then the government announces a blank check for funding household energy expenses because of high natural gas prices, and then announces a tax cut, which, if you see on the left-hand side, this is lower revenue and higher spending, the two of which amp up demand, which is the complete opposite of what the Bank of England is trying to achieve. So instead of raising rates to, say, 5%, the expectation would be that policy rates would have to go even higher in order for the Bank of England to bring about a lower inflation path because of the intervention of fiscal policy. And then we saw what happened in rates markets. We saw the political upheaval that came as a result. And that's the key. And that's where Scott's points about, politics, just sort of average everyday politics is what's important for markets, is that we are seeing central banks now dealing with the politics of inflation, right? And it's almost a monochromatic discussion about the policy outlook, meaning that it's a singular objective of getting inflation down without much of a discussion about what the risks are, not just the risks to the economy, but potentially the risks to the financial system. Because for rates to constrain the real economy, policy rates have to be much higher than what the financial economy can sustain. And that's what we've been seeing this year. We think this is still likely to dominate over the course of the balance of this year and into the beginning of 2023. So from a macro lens, we just heard from China. Also, typically when the global economy is teetering a bit like it is with recession implications, I mean, I think it's recession foretold. I don't really think that that's there's not much differentiation on that view. It's just how deep really is the question that people are asking. Typically, at least over the past several years, China has been able to amp up its policy rates, meaning cut rates or engineer some kind of credit expansion or use fiscal policy in order to support the economy. And what we're living through right now is a Chinese economy that's likely to be continually slower because of an aging demographic and constraints on the credit side, and a government that seems determined to focus more on geopolitical issues than domestic growth, and really isn't going to save its own economy, let alone the global economy. The global economy. So you can see, for example, on the right hand side, what's happened with policy rates and long-term bond yields. They've really not moved that much lower. There hasn't been that indication that China's coming to the rescue in the form of amping up credit, because there just has been too much credit. So we're of the mindset that that Chinese activity is going to be more muted, and that and Scott, I don't know if he mentioned this in the early parts of his comments, but we are likely to see in this 118th Congress still very much a bipartisan focus on national economic policy with an eye towards decoupling the U.S. economy from China, which has implications for the Chinese economy and likely has longer term productivity and inflationary implications for ours. And I don't mean to say that inflation is going to get more out of hand than it is. It just means that it's going to get more difficult for central banks to get back to what they consider to be, their target. So I don't have to show you inflation. You know the numbers. You know the sources. I don't think there's a whole lot of information here. So I'll leave it with this slide here. Our three themes, which have been guiding our view for the whole year. First off is that if there's going to be a central bank that's focused on fighting inflation, that eventually is going to have to pivot and focus on the economic consequences of fighting inflation, meaning, in other words, the politics of higher interest rates, meaning longer welfare lines, higher unemployment rates, weaker housing markets. That attention will shift them to pausing eventually, getting to a point where they lift rates enough. Our view is 5% is about the point where the Fed stops. They leave it there. They leave policy rates there. They don't cut rates. They can't. Inflation's still too high. So it's not a repeat of 2018 and 2019. It's a sustained higher level of interest rates on the policy side, and likely one that is still tight for financial conditions, and yet not one that brings inflation back down to target. There will be, because of this shift, because of this move from focusing on inflation to focusing on growth, I think that does create some added volatility in financial markets that we'll have to manage. I think inflation will be higher than the post-financial crisis period, but less than where we were over the last year plus, which to me means focusing on inflation exposures within the portfolio still being an important ingredient. And we have this third theme around net zero. I would just say that from my lens, if this is a policy objective, then the transition there is really important. We've just seen over the last year what happens when there's not enough of traditional energy sources to meet demand in Europe, where they've had to refire coal-fired power plants and turn back on nuclear reactors. This becomes, and I've always thought of the attention on climate change. Scott mentioned that as a key issue for Democrats. I always think of it as, if you can't put a meal on your table for your family, then that you're probably not going to be able to focus, at least politically, on some existential threat of changes in the climate. And so ensuring that there's enough energy to meet demand so that it doesn't become a complicating feature for economic policymakers like we've seen in Europe and the UK this year, means that that we can achieve a lower carbon path. And it's probably going to be the key large integrated energy players that are anyway moving us along that transition. I'm right now in Calgary, so I'm speaking to you from the prairie provinces. And just to say that right now, a lot of international capital is focused on Edmonton, because this is where there's a lot of activity on carbon capture and sequestration, and sort of a proof point on whether that is going to be a viable technology for reducing CO2 or not. But just to say that this year and even last year, there's been a lot of evidence that there's gaps in the ability to supply energy relative to the demands That may have come about as a high cost of capital. That may have come about as a result of pressures to lower carbon emissions. That I think is likely heading into a world where energy is, as an ingredient within the portfolio, something that's going to be more of a stabilizer, but also alongside other scarcities like in healthcare and in basic materials. So Leonard, I promised to speak for about a half an hour, and I think that's where we are. And for me, it's always really important to address what is on your mind and what's on your clients' minds. So because that that ends up being what we should be researching on and making sure that we're relevant. There's also a lot of subjects that I didn't touch on, like the dollar, like liquidity, quantitative tightening, positioning within the portfolio. So let me pass it back to you. I'll stop sharing and then let you take over from here with questions.
Kurt, thanks very much. We have a few minutes to take some questions, whether they've come in online or anybody in the room. Kurt, the question is, you in your discussion about the transition to carbon neutral energy, you said you didn't think that markets had fully priced that in. Can you talk a little bit more about that viewpoint?
Markets haven't priced in the full transition. Yeah, I think that's right. So this year, what we've seen is that both energy and clean energy have outperformed the broader market, which to me is an indication that that there's some shortage that's being priced because this is an environment where most sectors are down. You look across the S&P 500, a lot of the rate sensitive sectors have sold off. Energy and clean energy are both higher this year. Now, energy is, of course, way exceeded the clean energy return. So that, actually clean energy is down, excuse me. It's just not down as much as the market. So it's outperformed, but it's negative. What I would anticipate in terms of thinking about the pricing for clean energy and the pricing for moving on a pathway to net zero is a higher multiple than what we've seen for energy and for materials. And the reason why I say this is that for energy companies, the writing's on the wall when it comes to CapEx to increase production. There is some discussion in the U.S. about, and we'll just have to wait and see what the constellation of Congress looks like. But there is some provision to ease the permitting of new energy capabilities across the spectrum, right? Not just traditional forms, which could bring some supply online. But I think that the idea that a large scale project could become a stranded asset is restraining investment at a time when demand continues to grow. So from my standpoint, free cash flow generation off of traditional energy is going to remain strong. Balance sheets have been repaired. They were forced to be repaired because of high yields on below investment grade debt. And then I would think that some of that cash flow that's not going to CapEx will come in the form of increased dividends and share repurchases. That to me is a very positive overall backdrop for energy, at least over a tactical horizon. We can debate whether or not it has legs strategically. But on the mineral side, and that's the kind of the clean tech piece, because on clean energy, it's highly minerals intensive. And with the build out and the search for minerals, it's also very energy intensive. So I think that this is not priced when I look at the materials sector PE forward multiples. I think that this is, maybe there's some weakness in prices because of the potential for a contraction in economic activity in the first half, but copper prices have fallen already a lot. But it's this build out, battery battery technologies, lightweighting, windmills, solar power, all of this, which is probably going to be led to a large extent by many of the traditional energy players anyway. But there's going to be a lot of demand for materials that are currently either in geopolitically sensitive regions or are just difficult to get. And that kind of environment, to me, that scarcity is something that I want to own. And I don't see, as to whether or not the path to net zero is priced, I don't see that reflected. Now, the other side of it is, well, maybe the climate just is what it is, right? Maybe net zero, is a policy path that isn't really going to change much. We'll have physical effects from climate change irrespective. The UN warned about this yesterday. Those physical risks are going to show up in real estate. That'll be, coastal properties. It'll show up in utility generation. We remember last year in Texas. We are seeing it in California. It's in my home state, New Jersey. Effectively, what's going on with utilities is that they're just not right-sized for the change in the climate. The energy that they depended upon is not available. Droughts where it was hydro, hot conditions where you expect wind. All of this is really complicating, I think, the utilities earning stream. And that's often thought of as a sector that's got great defensive attributes, heading into a recession, right? Because we all pay our utility bills. It's one of the last things to go after, Netflix is the last thing, I guess, now. But the point is that I think there's equally an earnings risk to utilities that's not priced based on some of the valuations in that sector. It's rather expensive because of the view that it's safe in a period of weak or contracting economic activity.
Kurt, thank you for your time today. It's great to have you, and I think everybody here enjoyed your talk. I certainly did. And if we have any other questions that come in, we'll shoot them to you, and we'll be most appreciative if you give us a little short answer back, whoever asks. Thank you so much.
Will do. Happy to.
Hope your trip is good in Canada.
Thanks, Leonard. Take care, everybody.